we're going to talk about a topic that might sound a bit boring, but is actually super important: passive income and taxes. Don't worry, we'll break it down into simple terms so you can easily understand it. So let's dive in. Passive income is money that you earn without actively working for it. It's like making money while you sleep. Pretty cool, right? But here's the thing. Most types of passive income are taxable, meaning you have to pay taxes on them. However, there are a few exceptions, and we're going to explore those today. First up, we have tax-free municipal bonds. These are special bonds issued by cities, counties, and other local governments. The great thing about them is that the interest you earn from these bonds is usually tax-free at the federal level. Some states even give you a tax break too if you live in the same state as the issuer. Just remember though, any capital gains you make from selling these bonds are taxable. Next on our list is inheritance. If you receive an inheritance from a loved one, here's some good news. You won't have to pay federal taxes on it, no matter how big it is. But be aware, 6 states do impose inheritance taxes, so you might want to check if you live in one of those states. Now let's talk about life insurance. If you're named as the beneficiary on a life insurance policy, the money you receive from it is tax-free. That's right, even if it's a large policy worth $1 million or more. But remember, if you cash in the policy, instead of receiving a death benefit, you might have to pay taxes on some or all of it. Disability payments can sometimes be considered taxable income, but here's an exception. If you pay for all the premiums of a health or accident insurance plan, any disability payments you receive won't be taxed. So it's a good idea to have insurance coverage to protect yourself. Gifts. Who doesn't love receiving gifts, right? Well, here's the good news. Recipients of gifts never have to pay taxes on what they receive. However, the person giving the gift might have to pay taxes if it exceeds a certain amount. For 2023, that amount is $17,000 per person. So you're off the hook as the receiver. Let's talk about alimony and child support. In the past, alimony payments used to be deductible for the person paying and taxable for the person receiving. But since 2019, that's changed. Now, alimony payments are no longer deductible and the recipient doesn't have to pay taxes on them. Child support payments also fall into the same category. No taxes for the receiver and no deductions for the payer. Now, here's an exciting one: Roth IRA withdrawals. Roth IRAs are special retirement accounts where you can put your money. The best part is that when you take money out of a Roth IRA, as long as you follow some rules, you won't have to pay taxes on it. These rules usually involve having the account for at least 5 years and being older than 59.5 years. So it's a great way to save for your future without worrying about taxes. Did you know that if you go through a disaster, your state or local government might provide you with a disaster mitigation payment? The good news is that these payments are not considered taxable income. Also, if someone adopts a child, they might receive reimbursements for qualified adoption expenses. These reimbursements are also tax-free. Now, let's talk about a different way to save on taxes. Some states don't have an income tax. That means you won't have to pay state taxes on your income, but you'll still have to pay federal taxes. These states are Alaska, South Dakota, Nevada, Florida, Texas, Wyoming, Washington, and Tennessee. So if you live in one of these states, you can save some money. Okay, now that we've covered some tax-free income sources, let's talk about how to lower taxes on taxable passive income. Here are some helpful tips. Tip number 1, use tax-deferred accounts like IRAs and 401k plans. By keeping your money in these accounts, you won't have to pay taxes on your income and gains until you withdraw the money. In some cases, you might not have to pay taxes at all. Tip number 2, hold your investments for the long run. This not only helps you avoid paying taxes on multiple transactions, but also allows you to take advantage of lower long-term capital gains tax rates. Tip number 3, harvest tax losses. If you have investments that have lost value, you can sell them and use those losses to offset any taxable gains you may have. This can help reduce the amount of taxes you owe. And there you have it, a breakdown of tax-free income and tips to lower your taxes on taxable income. Remember, understanding taxes is important, and it's never too early to start learning about it. Stay tuned for more useful information, and don't forget to subscribe for more educational videos. See you next time.